All right, good afternoon then everyone, as we're at the beginning of another week of trading on Monday the 5th of February. Let's have a quick flick across the calendar on an extremely quiet economic calendar this week. I kind of double check all the countries are on it when I did look at it, but here we are. Not that much really to go through at the start of this week. Now we'll have a quick look back to the back end of last week where we can see massive US dollar strength over the course of Friday that has continued then into start the week then this week, and that is broad-based US dollar strength across the board. You look at equities now. Equity markets had weakness off the back of that NFP print on Friday, a pretty blowout jobs report from the US, downside to begin with, but then rallied back up past the highs and then continued, which was not to be unexpected really when we were looking back to we look previously at how these moves have unfolded. A massive, a big increase in jobs, or a substantial beat on consensus in terms of the jobs figures, not the unemployment rate, but the NFP print itself. Up near 350,000 with a consensus of 180. It nearly came in and doubled the consensus, right? And that then causes the markets to have a reaction, or the algorithms to have a bit of a reaction in some downside for stocks, right? Downside for stocks, obviously, strong labor market causes the Fed to be less dovish or more hawkish, whatever way you want to try and put it. That's obviously a very simplified way of looking at it, but then the markets turn around, they start to push higher as that just increases the soft landing narrative. One blowout jobs report is not going to make the Fed not cut interest rates. It's not going to make them hike interest rates. The next move for the interest rate in the US is going to be lower, and this just reaffirms the stance that they are going to be cutting interest rates into a economy that is performing well. Right, then normally when they cut interest rates, or normally when a central bank cuts interest rates, they cut interest rates into an economy that is performing poorly. Then it's just downright negative for stock indexes, right? Okay, stock indexes like interest rate cuts, but if central bank is cutting because of a dreadful economy, well then that's a situation where it's not too good for stock indexes really now, is it? And a bit of downside, pop back to the top side. Sorry. And pop back to the top side again, that reinforces the soft landing narrative. I think any economic data that continues to be positive, we've said it over the course of this year so far, any economic data that continues to be positive reaffirms the soft landing narrative as likely to cause some upside for stock indexes. And it is a situation where you can see US dollar strength, equity strength, and bond yield strength, which is not really a situation you get that much, but that's kind of what we're in at the moment. So it'd be interesting to see how the US open up now at 2:30. Do they give back some of those gains from Friday, or do they just accelerate off again? That obviously remains to be seen. You then need to look towards the economic data for the week, and really the only thing out of the US is this services PMI, which I know it's high impact, but it is certainly not one of the higher impact of high impact data prints. But ultimately, consensus is 52. That's positive print above 50 for any PMI, which is good. If you can beat consensus again, that's probably another situation where stocks continue to rally. So we'll be looking at that with a keen eye at 3 o'clock a little bit later on. We do have the unemployment rate out of Canada that is expected to tick up, and that's probably likely to keep the Bank of Canada on their path towards interest rate cuts. They have dropped the narrative, or dropped a couple of statements within their, or dropped a couple of sentences within their statement at their recent interest rate decision, saying that they are no longer looking at hiking interest rates. That is then off the table, moving more towards cutting. When that is going to be is obviously a totally different question. The economic data will help guide us in that direction. It's not an inflation figure, which is obviously the big hitters across the major economies in this day and age. It is the unemployment rate, but if that continues to tick higher, again, that's another reason to suggest that the Bank of Canada are proven correct, and they will have to cut at some point a little bit later on this year. The RBA we have out as the main focus of attention, certainly from an interest rate decision or a central bank decision. Now, back at their last meeting, suggesting they don't really want to hike rates further, but I mean, the gist of it was they kind of don't want to hike interest rates further, but they are prepared to, if necessary. Incoming economic data will continue to drive decision making within the RBA, and that's, is that really a surprise? No. Are we likely to get a surprise then tonight, tomorrow morning, whatever way you want to put it, wherever in the world that you are? Do they really change that? I would suggest probably not. They might remove some statements saying that they're not looking at hiking further, or say they're prepared to tighten further if necessary. They might drop that, like the rest of the central banks have done as well. That would be a dovish step. But ultimately, inflation is still a 4.1% year over year in Australia. I don't think it's quite time for that just yet. I still do think they need a little bit more time in order to get inflation down. So I wouldn't expect much fireworks from the RBA tonight or tomorrow morning, as I said a little bit earlier on. It means, where do you focus your attention then this week? There's not much on the economic calendar to point us in the right direction, so you got to go off what's been happening previously, and does that then continue? You see the reaction to NFP, and then the reaction on the first trading day of the year so far. US dollar strength, equity dollar strength to finish off the week. Equity dollar, equity market strength to finish off the week. Bond yields pushing higher. As long as these bond yields continue to push higher, it will continue to be supportive for the US dollar. I think US dollar strength probably the side of the fence you got to sit on this week. Equities, I'm a little bit more unsure about equities. I do think getting long dollars, decent idea over the course of this week. Equity markets, where they go, maybe a bit more of a tricky one. I mean, they're moving up, then they're moving down. They're kind of little bit, I won't say all over the place, because the direction is still pretty clear, but certainly not as clear as it was back end of last year. So you kind of get just kind of a normal trend in it. Higher lows and higher highs. That's probably set to continue. I'll be a little bit more confident in buying dollars, but we'll see how that pans out over the course of the week. As I said, nothing much to really get in our way in terms of the economic calendar. Nothing much as tradable opportunities in the economic calendar. Services PMI. Let's hope that can set the tone for the week. But dollars look bullish. Equity markets probably more bullish. Bond markets bearish, which is obviously yields higher, and that is kind of how we're sitting as we head into next week. Oil's the other thing to look at. Oil pushing lower, likely to do with a continuation of the struggling Chinese economy, but ultimately had a lot of upside. Oil, I say had a lot of upside. I mean, had a substantial bit of upside over the month of January, has given back pretty much all those gains. We're back kind of trading around where we ranged kind of first couple of weeks of January and back end of last year, and well, I say back end of last year through the month of December. So what we do on oil, I mean, the trend is pretty clear on oil, but I wouldn't be so sure on the direction. It's a little bit more difficult to wrap your head around at the moment. So yields pushing higher again is a negative for gold. Yields pushing higher is positive for the US dollar. So probably gold shorts, dollar longs, equity markets probably tilted to the top side is how I'm viewing things as we head into the rest of this week's trade.